Discussing Fee Models and Fee Benchmarking webinar. My name is Brian Montanez. I'm a principal with Multnomah Group and a retirement plan consultant here in Northern California. Our agenda today, we're going to discuss a couple basic terms that hopefully everyone will be familiar with, some considerations when we're talking about retirement plan fees, as well as record-keeping fee models for defined contribution plans, fee benchmarking in defined contribution plans, and share class analysis. Definition of terms. So I just want to level set so that everybody has a basic understanding of some key components of what I'm going to be talking about today. So revenue sharing. Revenue sharing is a portion of the investment's expense ratio paid to the record keeper for shareholder services. So it's included in the expense ratio, not additive to the expense ratio. However, an asset-based fee is a fee expressed as a percentage of assets assessed to all or some of the investments. An asset-based fee is additive to the plan's investment expense ratios. And thirdly, we have what we call an ERISA expense account. It's also called a revenue credit account, a budget account, a para account. Lots of different vendors have different names for it. What is it? It is an account established within the plan that receives money from the assets or vendor to be used for required or fiduciary expenses. And depending on whether or not you're subject to ERISA, it may be called an ERISA account, and it may be subject to ERISA rules, or it may not be. Some considerations for you as we move forward in this presentation. So first, the applicability of ERISA, the Employee Retirement Income Security Act of 1974. In plans that are subject to ERISA, the code prescribes the types of expenses that may be charged to the plan assets. There's settler versus non-settler. Settler is a fancy word for business decisions. For example, if you wanted to do a study to figure out if you should change your plan design, that would be a settler function, and you should not be able to assess those to plan assets. But required expenses, such as a plan's audit, or fiduciary expenses, such as investment consulting, all are considered required or fiduciary expenses and are non-settler functions which can be assessed to the plan assets. Now, if you're a governmental plan, governmental plans generally have greater latitude in determining what types of expenses are allocable to plan assets. Governmental plans are not subject to ERISA, so they don't have those ERISA requirements on fees as they relate to expenses. But they are subject to state laws, and depending on where you are, most of the state laws that I'm familiar with in the western states are written to model ERISA, so please check with your attorney on the applicability of state laws as it applies to assessing fees to retirement plans. Risks associated with plan expenses. So the risks are almost exclusively oriented to those being charged, either directly or indirectly, to the plan's assets. What do I mean by that? If you as an employer are paying for example, the auditor's fees or consulting fees or legal fees out of your corporate coffers, those are not fiduciary issues for the plan. You may have employer questions as to whether or not they're reasonable, but as far as the retirement plan goes, if the fees are not assessed to the retirement plan and paid by the retirement plan, it's not a retirement plan issue. So things to be considered with are the reasonableness of the fees charged by your vendors, and we're going to talk about that today when we do some benchmarking. The fairness in how the fees are allocated. You may allocate everything as a percentage, or you may allocate it as a per head fee, such as everybody pays 0.25%, or everybody pays $95 per year. As long as the fees are allocated in an equitable manner, and both those are considered equitable. The impact of share class decisions on plan economics and participant expenses. I wander through my career and I find that a lot of people don't actually sit down and review the net cost of the share classes. So I'm going to talk about that at length today. So here's the meat of our presentation today. We have 5 basic models. Now your vendor may call them bundled or unbundled. That's not what we're referring to. We're referring to how the models, the fee models, are created and how they operate. So we're going to talk about what we call a cost-based model, a revenue requirement model, a revenue sharing or target model, target revenue model, or a revenue sharing plus, which is a requirement and a target, or fund level equalization. And I'm going to walk you through all of those today. Additionally, we're going to talk about Multnomah Group's fee benchmarking report. So our objective is to clearly articulate the fees incurred for investment management and record-keeping services. Those are different fees. Often, they are both wrapped into the same, which is an investment products fees, but they need to be separately identified. We also want to be able to demonstrate the opportunity for price improvement of record-keeping and administrative services by benchmarking the plan against Multnomah Group's estimate of the market for all plans with similar demographics. So not what is your neighbor paying, but if you took your plan to market, what kind of pricing would you get? That, by definition, is reasonable when the market is telling you what they would charge you. Also, to provide actionable information for the clients to work with in evaluating the fees of their record-keeping vendors. We often find that people aren't aware of all the different fees or types of fees that exist in their retirement plan. What our benchmarking report doesn't do, it doesn't summarize all plan fees. For example, investment consulting, audit, legal. Depending on if you're ERISA or not, or subject to audit or not, you may not incur these fees. It does not include an audited historical fees that were charged by the vendor. What we're saying is, based on a point in time here today, based on your plan demographics, your plan design, here's what we think you could get in the open market. It doesn't identify party fees that are charged, and that's really more of a spelling error. I don't mean we're going to have a party. I mean which parties' fees are charged. So my apologies for that. Benchmark investment management fees. That's a separate issue. Our record-keeping fees, our record-keeping benchmark report does not include benchmarking of the investment management fees. We'll talk about that a little bit later. So the first of our models, the cost-based model. So in the cost-based model, fees consist of a combination of a base fee, per participant fee, and probably an explicit asset-based fee. The fees are aligned to the specific cost of service. For example, there may be a base fee of $5,000, $10,000, $15,000, and that base fee goes for plan document services, compliance services, discrimination, $5,500, maybe even disclosure mailings. Then there's per participant fees, usually a hard dollar number per participant. This is generally for the marginal expense of servicing your growing population, and it's for communications, web and call centers, and then other mailings that the record keeper has to do. And then there's usually an asset-based fee, which can be for, it could be for record keeping, but it's almost always for custody services in the cost-based model. The cost-based model is most typically found in unbundled record-keeping relationships with local or regional TPAs. And if you have that, you're familiar with getting a separate bill, an invoice for 5,500 services or participant services. The cost-based model is becoming more popular for plans with low turnover and higher average account balances. It tends to end up running a lower total cost rather than an asset-based fee when you have high account balances. Revenue sharing is typically credited back to either the plan participants directly or used to offset the explicit fees charged by the vendor. Remember, revenue sharing is a component of the expense ratio that's credited back to the plan or to the vendor. Here's a benchmarking report for the cost-based model. So I'll point out a few things here. Up here we have our base fee, $14,200. There are no participant fees, but there could easily be a $10, $20, or $30 per participant fee. And there is an asset-based fee of 0.7%. Down at the bottom, we'll see base fee plus participant fee plus asset-based fees equals the total record-keeping fees. So what we can see here in the matrix is all these fees add up to $19,051. That ends up being 0.27% of plan assets. Multnomah Group based on the work that we've done, the proposals that we have received, our work with the different vendors across all our clients, we've determined that a reasonable peer range would be 21 to 30 basis points. Again, this is what we believe, based on our work, you would get if you took your plan to RFP. So 27, while it's at the high end of the peer range, we would consider that fairly reasonable. On the right-hand side, you can see we have our transaction fees. Here you have distribution fees of $80, and that's at the high end of what we see. Loan initiation fees of $150, again, that's at the high end of what we see. But loan maintenance fees, not applicable. When you see high loan initiation fees, you very rarely see maintenance fees. They charge you one way or the other. Quadros, we don't establish a peer range. It can be anything from $0 to $1,500, but there's no real reasonable range that we have found. And then brokerage accounts. In this particular client, there's no charge for brokerage accounts. You'll see that where the record keeper is also offering the brokerage account. So they're charging on the left-hand side, so they don't have to charge for the brokerage account. But where you see a record keeper bring in a non-proprietary broker, maybe it's a Charles Schwab or a TD Ameritrade, and that those aren't your record keepers, you'll definitely see brokerage account fees there. So this is the cost-based model where we're trying to tie, where the industry is tying their services to their cost explicitly, because they often tend to be different service providers. Moving on, we have the revenue requirement model. This is where the fees consist of a stated revenue requirement expressed as a percentage of plan assets that the vendor needs to collect. It's inclusive of administration, record keeping, and participant services, so different than the cost-based model where everything is separated. The revenue requirement model is inclusive. The vendor is agnostic as to the payment method, be it revenue sharing or asset-based fees, or even paid by the plan sponsor. Depends on who you're working with. Fees are usually paid at least partially through revenue sharing payments. The key differentiator for this model is that the vendor needs to periodically reconcile the revenue it receives against the stated revenue requirement. And if there's a shortfall, they may come asking for a check. Excess revenue, should there be any, so how do you get excess revenue? Should the funds that you're using pay revenue sharing in excess of the revenue requirement, then you'll have excess revenue. The excess revenue can be credited back to an ERISA account or directly back to the participants. However, if there's a shortfall in the revenue, you may get an explicit charge or an invoice or at least a request to pay for those fees that are in shortfall. Here's the benchmarking for the revenue requirement model. So here, as you can see, there are no there are no base fees, no participant fees, no asset-based fees. The revenue requirement is an explicit 16 basis points. Now, at the bottom you see, note our analysis ignores how they get the revenue requirement. Fees may be paid from the plan sponsor, may be an asset-based fee, or may be revenue sharing. The key is it's a requirement that the vendor get 16 basis points for their services. Straightforward, clean, and depending on your fund revenue sharing, may be very economical. However, if you have revenue sharing that is in excess of the 16, you'll want to make sure that you reclaim those excess revenues. Then we have the revenue sharing target model. This is where the vendor collects revenue sharing sufficient to subsidize their record keeping and administrative fees. Frequently quoted as a revenue requirement during the sales process, it does not include any periodic reconciliation of revenue related to the quoted fee. So there is no excess fees returned to the participants. The vendor keeps everything that they get from the revenue sharing. You can create an ERISA expense account that is funded by a set amount annually. So occasionally we'll see clients who will have the revenue sharing target model where the funds are all paying revenue sharing, and unfortunately you have to work with the vendor to make sure that any new funds have a revenue sharing requirement. If there's excess revenue, you may be able to negotiate that something gets put into a revenue credit account, Or you may be able to add an explicit asset-based fee, such as 5 basis points on plan assets, that can be credited to an ERISA expense account and used for fiduciary expenses. In this model, it's the vendor who takes the risk to collect the revenue from the investment managers. If there is an internal shortfall, as in they haven't told you exactly what they want from you, if there is a shortfall, it's the vendor who takes the risk, so they don't collect as much money as they'd hoped to. As I mentioned, fund changes are most difficult because they have a pricing impact. So you have to work with your vendor to make sure that any funds that you're going to put in the plan have a revenue requirement or have a revenue sharing that are meet or are close to the revenue sharing requirement that your vendor is looking for. Of course, what this means is you're only dealing with half of the investment universe. So no Vanguard funds, because Vanguard doesn't pay any revenue sharing. Periodic price reductions are done through the use of less expensive share classes because, again, they're getting paid by the revenue sharing from the fund. So if you get to the point where you can reduce the rate of fees that you're paying to the vendor, you would have to do that through a share class reduction. It's most common in small plans. So let's see what that looks like. So in our fee benchmarking report here, no basis points, no participant fees, no base fees, all the $147,000 is coming from revenue sharing. So we can divide the $147,000 by the total plan assets and determine that the vendor is receiving 19 basis points. In this model, you can see that our peer range is 13 to 20, so we're at the very high end of the peer group range. If you wanted to reduce that 19, you would have to go back and negotiate a lower cost share class of the same funds that you have in the plan. It's possible, it's just a bit harder than just reducing your explicit contract fee. Moving on, we have the revenue sharing plus the requirement and target model. So in this model, the revenue sharing plus, the vendor collects revenue sharing, but we all know it's insufficient to meet their total revenue needs. So you may have some low revenue sharing funds or some no revenue sharing funds, and that's going to need to be subsidized. In addition to the revenue sharing and vendor charge, in addition to the revenue sharing the vendor charges, additional fees such as a base fee or per participant fee or asset-based fees will need to be levied. Implementation of this model takes many forms depending on your vendor. It does provide greater investment flexibility than the revenue sharing model because any funds that you do want to use, again, using Vanguard as an example, they don't pay revenue sharing. Therefore, the record keeper will not receive any fees. In this model, you can assess a fee either to the total plan assets to make up for that shortfall or specifically to the funds that don't pay revenue sharing. So much more flexibility here. What does this look like? So you may have a base fee here, which is $3,000. You may have participant fees of $40. You may or may not have an asset-based fee, depending on what the total fees look like. So in this model, the revenue sharing from the funds is $7,451. Add that to the base fee and the per participant fees, and we end up with a total of $11,851 being paid to the record keeper for this model. That ends up being 23 basis points, which, as you can see, is at the low end of this peer range. So here we have the base fee and per participant fees, plus any asset-based fees, plus any revenue sharing equals the total record-keeping fee. 23 is the sum total of all the above fees. Moving on, we have the fund level equalization model. This is by far the most complicated model. This model, the fund level equalization model, the vendor has a revenue requirement for the plan stated as a percent of plan assets. For each fund in the investment menu, they determine the fund's revenue sharing. The difference between the fund's revenue sharing, or lack of revenue sharing, and the revenue requirement is charged to the individual fund or credited back to the individual fund. What do I mean? So in our graphic here on the screen, we have Fund A and Fund B. So the second column, we have the plan revenue requirement. Our agreement with the record keeper is 16 basis points. we want to be fund agnostic so that we can have whichever investments that we want. Here we have Fund A. Fund A has a revenue sharing of 10 basis points, but 10 is less than 16. So the record keeper needs to add a fund level wrap fee in our fourth column of 0.6%. 0.1 plus 0.06 is 16 basis points. Fund A is being charged 6 basis points on top of the revenue sharing to get to the 16. However, Fund B has revenue sharing of 40 basis points, which is far in excess of the revenue requirement that we need. So Fund B, within the same plan at the same time, is going to be credited back 24 basis points. So depending on the fund and the revenue sharing, you may have a credit or a charge to the fund. This method is really difficult operationally to get correct because of the number of moving parts. It creates challenges with participant communications because some funds are getting credits, some funds are getting debits, but in the end, it's a very equitable way, in my opinion, to assess the fees to make sure that everybody is paying an equitable amount, as in everyone is paying 16 basis points. So let's look at how this looks in the fee benchmarking report. So no base fees, no per participant fees, no asset-based fees, but there is revenue sharing on some of the funds, and I'll walk you through that in a moment. And there is a fund level wrap fees. So I say fund level because it's not plan level. It's not on all plan assets. It's only on specific funds. So let me show you some examples. Down at the bottom we have the Causeway Fund, which as you can see has a revenue sharing of 10 basis points. But as we talked about, the requirement for this is 16. So this fund is going to have 6 basis points added to the total cost. So the 10 plus 6 equals 16. ClearBridge, however, pays no revenue sharing, so a fund level wrap fee of 16 basis points is added. But if I go down to Northern pays 40 basis points, so the revenue sharing is $1,700, but that is far in excess of what the plan sponsor needs, or what the record keeper needs. So 24 basis points will be allocated back to the Northern Small Cap Fund. So in this model, that fund is going to get $1,022, and it's going to be divided out pro rata to each participant that is in the plan. The best record keepers are able to do this on a daily basis, so you don't have the question of, well, I was in the fund on one date, but the credit happened on a different date. The best record keepers can do it on a daily basis and track every individual participant on a daily basis. So then looking at the peer group range, 18 to 38, so we're at the low end of the range, so we don't have to worry about offsetting fees. But if we did, say we came in at the high end of the range, we could just reduce the 16 to a smaller number, 15 or 14 or 13, and then all the fund level wrap fees would be adjusted based on whether or not they're being overpaid through the revenue sharing or if they're collecting less than they need via the revenue sharing. So we have an adjustment mechanism. We don't have to make fund changes. We don't have to go through all those fund change notices and actions. It's a very simple way to address an equitable allocation of total plan fees. Share class. So I've spoken about this a couple times today. The purpose of the share class analysis report is to demonstrate the complexity of the investment marketplace, to educate our clients on the difference in share class availability, and to provide an introduction into the topic to determine whether additional analysis of each share class is needed. A secondary purpose for the share class analysis report could be used to verify the plan is currently using the least expensive net of revenue sharing availability. Net of revenue sharing available share class if it happens in the reporting that no cheaper share classes may be available. So in the first model, the question is are we paying enough revenue sharing to cover our expenses, or are we paying too much? In the second model, the question is, I don't care about revenue sharing. I want the net lowest cost, if it's with revenue sharing or without revenue sharing, investment available. So I oversimplify in my graphic here, but the point gets communicated fairly clearly. First, we have the Vanguard bond market. It's the investor share class, and it costs 20 basis points. There's no revenue sharing, so the net expense is 20, and you only need $3,000 to get into it. However, if you had a total of $10,000, you could get into the Admiral share class, which has an expense ratio of 5. And if you have $5 million, you can use the institutional share class with an expense ratio of 4. And if you have $100 million, you can use the institutional plus and get down to 2. I'm often surprised when I take over new clients and they have a simple model like this, and they've got $7, $8, $9 million in a Vanguard fund, but they're still using the investor share class, which is they're absolutely just leaving 16 basis points of free money on the table. Would this be a revenue sharing question? You'd have to look at the net of revenue sharing. It would be very easy to find a fund that has revenue sharing, and the revenue sharing may be different depending on the share class that you're using. So depending on the cost model that you're using, you may want higher revenue sharing because that's your requirement for paying. That's your vehicle for paying the revenue required by your record keeper. Or if your record keeper is fee agnostic, such as in fund level equalization where they don't care, they're still going to get their 16 basis points, you'll want to use the share class that has the lowest net of revenue sharing expense. Please feel free to email me or call me with questions about that. I know it's not as simple as I've made it sound. Share class considerations. So the client's fee model, depending on which one of these models we've talked about, will dictate to what extent alternate share classes could be considered, should or could be considered. The share class availability is dependent on the record keeper and the investment manager. So there's no public database such as Morningstar or Yahoo or Standard & Poor's where you can go and get reliable share class information. Each share class question has to be asked and addressed specifically with the vendor. We've seen where one vendor has revenue sharing of 25 basis points and a completely different vendor has revenue sharing of 30 basis points, same product. I've also seen one of the biggest vendors in the country where they give an additional 10 basis points of revenue sharing credit when you use their proprietary funds. So it's not a simple answer. You need to work with your record keeper to figure out what the gross expense ratio is, what the revenue sharing is for them, and then what your net revenue sharing is. So as I say, newer R6 share classes may not be set up by record keepers yet. What is an R6? So R generally stands for retirement, and 6 tends to be, in the numerical order, 1 through 6, the cheapest share class. However, you may have to ask your vendor to add the R6. As new funds and new share classes come out, they're not automatically added to your record-keeping platform. But you may request it, and they may or may not do it, and they may or may not do it for free, but it's worth asking. Investment managers have different policies on investment minimums for retirement plan clients. I've seen where many funds waive the minimums for retirement plan clients, but enforce the minimums for retail clients. So you may go to Morningstar and see that this fund has a $100 million minimum, but in fact, it's waived for you because you're a retirement plan. So again, work directly with your vendors to figure out what share classes you have available to you. The record keeper, each individual record keeper, is the only one that can tell us whether the funds that may be available are actually available for the client on their platform. Our belief is that best practice is to separate the investment management and record-keeping fees by using the institutionally priced or zero revenue sharing choices. That makes the investment management fee explicitly clear, and it makes the record-keeping fees explicitly clear. There may be an opportunity to arbitrage fees with higher expense ratios that have a lower net investment management fee. This opportunity is probably going to decline as the mutual fund world catches up with what the retirement plan world is doing. But just because your expense ratio is the lowest expense ratio of all of those funds does not mean that net of revenue sharing, it is the lowest net cost. I don't want to say often, but more often than I'm comfortable with, I'll find a higher expense ratio fund will have a lower net of revenue sharing total cost. But also look for opportunities beyond the whole share class adjustment, particularly with index funds. In theory, all index funds are the same. However, here we can see a pricing difference. For example, the principal large cap S&P 500 index institutional share class has an expense ratio of 16 basis points and revenue sharing of 1, so the net cost for the principal S&P 500 index is 15 basis points. But with the same amount of assets, you can go to Vanguard and get an expense ratio of 5 basis points for the exact same product. So here, it's not a share class question because principal is going to give you the lowest share class. However, Vanguard straight up charges less for their product. So some action items for you to consider. Gather and read all service agreements to identify fees and associated services. Now, I know this is not an easy task. Obtain 408B2, which is a required disclosure that you should be getting every year. That's a little bit easier to read than your contracts, but understand not all fees charged to the plan, for example, fees paid by the plan sponsor, not all fees charged to the plan are going to be identified in the disclosure. Many vendors identify all fees because it's fees that could be charged, but not all vendors do. So the 408B2 may not be comprehensive. Solicit feedback from those who operate the plan and participants on the satisfaction with the vendor. Because fees are what you pay, but as Warren Buffett said, value is what you get. And if we're going to be considering our fees, we have to consider what we're getting for our fees. Consider unique plan designs that increase the cost of service. If you have challenging plan designs, you may have higher discrimination tests. You may spend more, your vendor may spend more time working with the operations of that plan. So you need to consider how unique your plan is. And consider the amount of on-site service received. The amount of education days or committee meetings that you hold where the record keeper sends out people, that's a real cost. If you have a lot of on-site days, there's going to be higher prices, higher revenue required to pay for those services. And compare fees and service to the available marketplace, not the peers. We often see where peers do not actively manage their plans, and it's the rare occasion, but it does happen, where when we're brought onto a new plan, that we don't find price reductions. So when we look outside of what your peers are doing, that's not really a good way to benchmark. Look at what the market would give you should you choose to hire them. And finally, and I wish I would have put this down there, periodically audit the fees that are charged or assessed to your plan. Ask for a reconciliation from the vendor of all fees assessed. It's a good thing to do at least once every couple of years, and your vendors can do it for you. I have some additional resources here for you. They're all on our website, moltenlombardgroup.com. The first one is a guide to retirement plan fees and expenses. It will explain all the different types of fees that exist in retirement in a very detailed manner. Expense accounts. As I mentioned earlier, an ERISA account, they come in many forms and functions depending on the type of organization you are, be it a governmental entity or a nonprofit organization or a for-profit organization, and depending on whether or not how your vendor sets them up. So we spend some time exploring all the different types of expense accounts. We have an FAQ on fee reasonableness. It talks about the different ways that you can assess fees and how to determine if they're reasonable. Trending towards fee equalization, the one that's more complicated, I think it's actually probably in the best interest of most mid and large size organizations, so we wrote a paper on that. And then we have a paper on conducting a vendor search, the benefits and best practices. With that, I'll repeat, if anybody has any questions, please feel free to email them to us. We will get back to you in writing. And I thank you for your time, and I wish you all a happy holidays. Take care.